Okay, thank you. So that was the, I guess, more policy, big ideas oriented portion of our programming. Now, I guess we'll get into the nitty gritty of what it's like to really run some of these businesses. So I'm going to start. We have Tony Tameldon, who's owner of The Pug, Brooklyn's Finest, and Union Trust. And I'm going to let you explain in a moment precisely where all those locations are, because I'm not from DC, so I don't know, I'm sorry. We have Keisha Cash, founder of Impact America Fund, and then Brandon Rule, president of Rule Enterprises and owner of The Caged Bird, which I believe is just like a 10-minute walk north of here. Am I right? I'm getting that right. Tony, where are you, your establishments?
So first, real quick, I want to tell Andre that Chuck D follows me on Twitter. And later, I have a lot of feels already from this whole thing. As an owner, and yeah, that white guy, I'm the white guy on the stage as a white business owner. I'm going to talk to the guy from Anacostia later, so can I find you? So I own Brookland's Finest. It's in Brookland, which is in Northeast, up by Catholic University. I own The Pug, which is a little dive bar on 12th and H Northeast. And then I own a place called Union Trust. It's in the whitest neighborhood in DC. I'm a block from the White House. Those are my places. And I just looked it up while we were out there. I got a 4 on Yelp, and probably because I'm a white guy, I never check it.
Well, we should start. We should talk about a little bit about when you open these places, what that process was like, and how have you noticed any difference in kind of your customers, your revenue, what it's like getting capital, what it's like growing your business, depending on the location of your 3 businesses?
Well, and I can only speak for DC, but it's gotten exorbitantly expensive. In 2005, I bought the building on H Street, and I got 15 guys together, and we scraped up $100,000. And then I went to the bank and turned that into a loan to buy the building. And then 2 years later, I finally got it open. I'm still trying to pay them back because owning a business is awesome. Then the same thing for Brookland's Finest. We gathered up 7 guys and raised $200,000 and got some clever loans from a local property owner. And then the one downtown was just the building was looking for a tenant, and they needed to fill it for a bank, so we got in there. And I think that, again, like the problem in Anacostia, it's too expensive. My business, the restaurant business, you need the checks, you need the staffing, and we can talk about programs too, because one of the problems I think in DC, even though there's probably a ton of programs, we have a small labor force of people who aren't lawyers or lobbyists, who people can work for a living. I can't hire enough folks, so I don't know if programs are the answer, but you guys probably got to go to Bowser and get some kind of, you can't afford to run a restaurant in Anacostia with the rates that they're already charging for the property, and that's gentrification. It's whoever owns the property. It's just too much now. And on the H Street, my biggest detriment right now is my property taxes. They just go up and up and up. So, yeah, but definitely go out and open your own business. If you can get a check, it's awesome. Like 6 months ago, I had a full head of hair. So just, but I think that they need the checks. But as far as programs are concerned, I do sort of feel a little different because there is a labor shortage. I think that, the Wharf and all these places in DC have opened, and they're continuously short-staffed. And meanwhile, in Anacostia, the unemployment is staggeringly high. So there has to be a way to bridge that gap. The Cheesecake Factory is opening downtown, and they're going to need 3 shifts of 60 people. And we don't have that. We don't have that labor pool in my business in DC. So I understand that programs aren't always the answer, but somebody, in addition to the checks and probably incentives from the city and the federal government, and it's so easy dealing with the federal government, right? Just a few pages here and there. But I think that there needs to be a lot of, it's not like America doesn't own the black community, so the more money they can give them back, you have to get incentives because as far as my business is concerned, the margins are too small.
That's a really important point about I guess what we would call it in policy circles is a skills gap. But yeah, on the ground, it's people that, there's unemployment in some places, there's a need for skills, and they're not being matched up, and how we get around that. But Brandon, I wanted to bring you on this point about the property, and you're doing real estate, and how, tell us about rural enterprises and kind of your vision for that, and with the affordable housing, and why you've gone about it the way you have, because I'm gonna let you explain.
Cool. So I own a commercial real estate development firm, initially rooted out of Milwaukee, Wisconsin, but now I'm based in D.C. I specialize in affordable housing because that's my passion, that's my background, and everything I do is for community. And the reason really why I got into affordable housing, in addition to that being my passion, the barrier to entry into that is a little different in terms of like developing your company. When you're doing market rate housing, attracting equity and doing things like that can be difficult when you're coming from communities of color that may not have the resources. But when you're doing affordable housing, you can actually identify parcels, you can get them under contract, and then use your knowledge and expertise to leverage a position that then allows you to find a partner that can be a capital partner as well as a development partner. So that was the initial structuring of my company. And now that I have a little more capital and more resources, I'm expanding into other areas and markets, which is why I moved to DC shortly thereafter.
Yeah. And so, but what is that process in terms of like getting started with IID? You said it's a little bit easier if you're going kind of the affordable housing route, but I think we all know that like affordable housing, the country is not awash in affordable housing.
For sure, yeah. So I think easier is the wrong term. I think it's a little bit more tangible for someone that doesn't come from an abundance of capital, simply because you can use knowledge as the arbitrage. Like you can use that as the leverage you need in order to build. And frankly, affordable housing is a very scarce thing because the values are increasing across the country. Where we are in the real estate cycle, frankly, because of that increase in pricing, it makes the cost of acquisition really, really high. And when you have the compounded construction prices put that into the cost of acquisition, really the margins on real estate are really, really bad. So affordable housing is a benefit because you're able to leverage resources that can fill that gap. And we're talking about, in the previous panel, government resources that can fill that gap. That's effectively why it's a little more tangible because of really the cost of capital. Like if you're developing a market rate project, I don't want to get too deep, but an IRR, for that maybe 20%, like the returns on that. So to your point, the cost of capital for market rate development, when you add in acquisition and you add in construction, there's no deal, right? But affordable, you can identify undervalued and underpriced assets within communities and effectively leverage those financial resources to develop the projects.
I feel like you can use the Brookings map literally to identify those places. Andre already set it up for you. Keisha, can you tell us a little bit about Impact America Fund, but also how you got to founding that? I think that's an interesting story or background to it.
It's a very long story on how it came to be, but I grew up economically low income in Orange County, California, which is a very high income county. So that's an interesting way to grow up, not having many resources at home, but seeing what resources can provide. And I benefited from great public schools, attending UC Berkeley, working on Wall Street, and go Bears. And was able to package that up into what is now Impact America Fund. Impact America Fund invests in founders who are mission-driven. They want to build big companies, scalable companies. These companies are typically tech-enabled or software companies. And the goal is to prove that you can scale and grow a business while reinvesting in the community and providing more economic opportunity for the community. So that's a tall order when you think about traditionally how businesses have worked and only focusing on a single bottom line, the profit line. And we're a part of a community of quote unquote impact investors who say that there should be ways that you can actually achieve both.
I think one of the things that really matters here is also that as a Black female investor, and like you're one of very few, and that's really important to address, is that we talk about how to access capital, whether it's through banks or investors or through your network, but what really matters is like who are the people who can do the investments, and when there are so few minority investors, it becomes really, really hard to increase that pool of investments that way. And so I'm going to give you some statistics because I'm an economics journalist and I like numbers. But one of the things that I found really striking is that only 0.2 women of color entrepreneurs receive venture capital funding, like 0.2%, less than 0.5%. And so I think I just pulled it out because it's shocking to me that you can have like that statistic could even be so low. But how do you go about kind of finding, again, about this point to network of matching people? Because this is what kind of keeps coming up, even to your point of it's about bringing the right people together. So you're based still in Orange County, but how does the companies that you work with reach people in all different parts of the country, and how much does location matter?
Yeah, and that's really the beautiful part about our thesis and the focus on software and tech enablement, and that you can reach you can scale faster, hopefully, and reach more people. But we're not doing it to leapfrog the community. So as an example, there's a company that we're invested in. The name of that company is Maven. Maven is a tech-enabled business based out of Oakland. It is a Black founder who grew up in Oakland, was educated at a Black college, lived overseas, speaks Mandarin, so is in a good position to manage a global supply chain. This company has raised, and I'll tell you what the company does for those who don't know it, but this company has raised over $50 million of venture capital to support the growth of the company. And it's a company that's disrupting the Black hair care industry. And the disruption is about acknowledging the assets of Black hairstylists in community and their contribution to the growth of an industry that they receive very little of the pie in doing so. And so through the use of technology, Maven isn't reinventing the wheel, it's leveraging the assets, those Black hairstylists in community, and saying, you are a true stakeholder and you deserve a bigger piece of the pie. Let's work together essentially as a collective, if you think about the way that the business is structured, so that I can apply technology, manage a supply chain, provide you an opportunity to increase your income on a weekly, annual basis by doing what you're already doing. And there are details as to how that's happening, but it's happening in a real way. And a little over 4.5 years, Maven has put $20 million of cash back into the pockets of independent hairstylists across the country. The majority of them on this map are located in the South.
Brandon, can you talk a little bit about, as well, about this idea of networks? Because you mentioned when we spoke before about the next idea being about crowdfunding and how that works. And just to kind of Martha's point on the previous panel around how do you keep protections for investors while also expanding the pool of people who can invest?
Yeah, I think my crowdfunding platform is really to scale, right? We talked about the type of industries that we're working in, and being in affordable housing, it's a very cash-intensive business. So really, the crowdfunding platform, Tech Enable, it's really a real estate syndication firm that takes advantages of some of the changes in the SEC laws. So accredited investors back in the 30s, the regulation that changed in the 30s then stopped retail investors and really most Americans from investing in real estate. So if you think about the appreciation from the 30s until today, it wasn't until the Jumpstart Our Business Act back in 2012 that then allowed for equity crowdfunding and allowed for most Americans to then be able to participate. So the thesis of that company is really to enable really all of Americans and primarily people of color to be able to benefit from the real estate investing and the the benefits of commercial real estate investing and democratizing that process. So in terms of protections, I think it's important for companies to then build opportunities for investing, whether that be through crowdfunding or other vehicles, but then also have the expertise on the other side to be able to be that thought leader, be that really advisor in that real estate space or whatever the case may be. When I'm thinking about capital in general, I want to rewind a little bit because it's really important types. Real estate capital is very, very different from venture capital, which is very, very different from crowdfunding capital. And then also just understanding on a lower level, like debt is extremely different from equity. And the cost associated with each one of those types of capital is important. And then also understanding the difference between our access and the cost of that capital for each one of those types in communities of color versus majority communities.
Just want to explain a little further for what your experiences with those various types of capital.
Yeah, so mine, going to the retail space, right? So I own a bar in DuPont Circle, and what I did there was just pull together a bunch of friends. So there's about 15 owners. It's 100% Black-owned, operated, staff, and finance. And I did that because I knew with my previous experience in lending, like my background is in lending. I worked for 2 CDFIs in a previous life, so I was on the ground. I was in the Ward 8s of my community trying to connect to the business owners and trying to give the capital that was perceived to be available and connected to the businesses. But there's a disconnect. There's a disconnect between what, specifically in debt capital, there's a disconnect in what they would like to see and then what the businesses have to offer. And if you think about even like the 5 C's of credit, right, that guides the ability for this decision making around the capital that's available. Oftentimes, there's a lot of bias within that. And oftentimes, there's not a level of understanding of those communities when they're providing that type of capital or even raising the money to then distribute it. So I think it's also important now that we have different types of capitals that are emerging, whether it be equity crowdfunding, whether it be venture, for the fund managers of those capital institutions, whether it be an internet platform and or, you know, a group like the Impact Fund. It's important for us to understand what these businesses are doing on the other side. And frankly, because of that, I wasn't able to attract the capital for a retail, restaurant, bar, lounge in the Washington, D.C. area. And frankly, you pair that on with the cost of the lease and, like you mentioned, the cost of labor. I think not only is there a labor issue, the issue around labor is, frankly, you know, in D.C., the minimum wage is rising, right? So historically, you may have had a manager that was making $17 an hour. But now if the minimum wage is $14, they can literally just go work at insert convenience store here and then supplement that cost with an Uber. And now your manager, that level of talent has then left the industry altogether. So I think there's a downward pressure on small businesses when it comes to even the cost of that labor that is really affecting the sustainability of these small businesses moving forward.
And do you have any thoughts about, I mean, while we have so many policy people around us and what you would want to see, right? Like if you and Tony kind of describing a really similar problem in the retail space, we're in DC right now, like what would help with that? Yeah,
I think if there was some credit, you know, some level of a credit for businesses under a certain threshold. You know, a lot of these big corporations, which in theory, they were the ones exploiting this very like labor issue and paying minimum wage to all of these employees, are offsetting that labor through technology. So the ones that are being hit the most are the small businesses. So if there is a relative threshold that you can have that earns a credit at the end of the year or whatever the case may be, I think that's a way to offset that. Yeah, that would be kind of the number one thought in my mind.
Tony, can I ask you to add to that if you have anything else you would want to see? You mentioned already, like, yeah, what are you going to do about finding people for the jobs? But
I mean, the minimum wage going up is difficult, and I think that part of the problem, it's always a small thing. People think, well, we raised minimum wage, and I think it might be 15. I feel like it's 15.
Yeah,
I feel like it's 50, but. So we raise it to 15, but there's not enough affordable housing. Or we raise it to 15 and there's affordable housing, but it's in Lorton, so now the guy has to drive to come up here. And so I think everything is a bigger, and I'm not saying you were painting it as a small picture, but these pictures are too big, and we don't have the wherewithal. I don't have the time to sit and say, this is we need all these things, but we need all these things. And then, of course, there's the thing that I pay my business. The Pug made, I don't know, like $12 last year, and I paid $8 in federal taxes, and Amazon didn't pay anything. So I think there's these broad things, and maybe they paid that, and I just saw it on Twitter. I don't know, but I think it's just, I think that it's broader than we have the capability of currently. I mean, I worked 2 blocks from the Capitol behind the bar for 15 years, and I'm 2 blocks in the White House, and I don't have a lot of faith in the people that we have there linking minimum wage to affordable housing, to transportation, to all these things. I don't know if anybody knows Horace and Dickey's. It's a place by the Pug, and it's closing. And one of the problems is parking. And they closed the 2 blocks for deliveries because when they were voting on the trolley to nowhere, they didn't give it a dedicated lane. Had that trolley connected Minnesota Avenue, it would have cut the transit time from Minnesota Avenue to Union Station. If you take the X2, it takes, I don't know, an hour and a half. If you take the trolley, if they got it all the way there in a dedicated lane, it would have taken half an hour. So you connect that community, but everybody voted no on a dedicated lane, so we had to take away the parking, and now Horace and Dickey's is, I mean, and there may not be other things, but it's going to come down to the hairdressers are the only businesses that survive, because nobody's going to a shoe store anymore because they can get Amazon, and then they don't pay taxes. So it's perfect. It's a perfect disaster.
I think
Sorry. Yeah, I want to add to that point around, it's a bigger question around how do we get people rewarded for their contribution, right? How do they actually get the real value for their contribution? We're invested in a company that's in the home healthcare industry. And in doing our due diligence for that investment, I was shocked to find out 60% of the women that provide the care in home health care are low-income women of color. And these women can barely make ends meet in such an important industry. And on the other side of that, we're seeing private equity strategies and roll-up strategies. Someone's making a lot of money in the home healthcare industry, but that money isn't landing in the hands of the people that are actually doing the work each day. So there's a big discussion, what Ty mentioned around narrative change and value that has to happen in this country, because then that connects the dots back to the policy change that has to happen, right? If the federal reimbursement rates for home health care are so low that then the service providers can barely make ends meet, then we have to question what those rates should be as we are facing in this country an aging population. So it impacts all of us. But there's a real mismatch. And similarly for the hairstylists, there was a business opportunity there because those hairstylists have been undervalued as part of the supply chain. A hairstylist essentially in any community is a recommendation engine. If she tells you to go buy certain products, you will go buy those products. Well, in Black communities, the places where she recommends you to go aren't owned by Black people. So you're being recommended to buy products, you're spending that money, and you're spending that money 2 or 3 times more than your counterparts because of the complex nature of your hair. That dollar spent isn't recirculating back in the community. So we're really looking at supply chains. Who owns different assets throughout the supply chain? Where are dollars being spent? Where's our time being spent? And can you start to reshape the pie using technology and software, again, not to override the community, but to re-engage the community in a way that gets them more value for their time spent?
I think we're raising kind of an important point around when it starts at the top of that, which is with federal policies that make economic sense in theory. And so that's why, as soon as you bring out the minimum wage, right, there's the data, the economic theory does support it, and so it makes sense, but then you have local businesses that say, okay, if you do this one thing, sure, that should make everyone better off, but if you don't have the housing, if you don't have the transport, and to Andre's point that we've had, the investment in these whole communities and areas, not just this is the one bit of the policy that we can get through and we can get to work, or the companies that have decided this looks good for us. So when you have Walmart saying, we're going to increase our minimum wage, and then everyone else is like, gotta do that too. Walmart doesn't care that the other businesses that it's pulling up too for minimum wages are struggling, right? That's not what matters. Good for it.
So with the $15 an hour, so at one of my places, we just don't have bussers and barbacks anymore, which historically was the best way to get into my industry. The best guys behind the bar and the best people on the floor started as bussers and food runners, and that, I mean, this is very nuts and bolts, but at $15 an hour, I can't pay the server and the next level down. So that next level down disappeared. I make the server do all of it. And so now you've lost an entry into this job where you can make some money, but now you don't even have, that entry level is gone. And so yeah, I mean, I'm not saying that people don't deserve a minimum wage, and it's minimum wage, not living wage, which is another thing.
Very different thing, yeah.
And that's, I can't believe you think there's a problem with healthcare. I mean, it seems so.
You're right, but then you have people doing twice as much work because it's more difficult. Also, Tony and Brandon, you both mentioned that the way you were able to make your DC establishments work was by getting a group of people together. Like, that was the key to starting it all. And I think it's really interesting that's like, you have two people in similar industries, and that is the exact same experience that you've had together. Like, is there any other way?
I think equity crowdfunding could be it. I mean, it's essentially the same thing. That's a private group as opposed to a public group. But I think being able to create your own terms around what that price is per share that you're kind of selling is a way. Outside of that, traditional debt is not really being offered at this point because, as we see, many of the Black-owned, home values are decreased. And then, frankly, millennials in general, regardless of race, aren't really owning homes at the same rate as they historically have been.
That is true.
So if you think about the backbone of business loans is typically the collateral. And now the collateral isn't offered, then there's no collateral for there to be leveraged. So now you have no leverage in your business. And the only way that you can supplement this capital by not having leverage, another word for debt, is through equity. And I think oftentimes, to the points that were made earlier, a lot of these business types aren't necessarily ones that can attract venture debt. They can't attract private equity. They're not scalable enough for those. They're not giving 3x equity multiples for the next funding round. A lot of these businesses, barely have a 10, 15% profit margin on their own surface. So again, I think the only true way to do it moving forward is at a low cost rate through equity crowdfunding.
It's interesting about also what that definition of success is, right? Like, why do you have to have a crazy double-digit profit margin to be defined as success in a time when we think about, like, what does economic growth even mean? If we have I can't get off the stage without bringing up climate change, but I have to, because it's one of these things where we talk about growth and growth for growth's sake, and people say we can't do that. So why does everything have to be about, like, why does that definition of success just have to be like crazy amounts of growth? Why not can we go for sustainable growth in these businesses that have a lot to offer, but maybe they don't have the returns that private equity want?
I think it's just the cost of capital. So having that conversation about how much the capital is for the type of capital that's deployed is really that value. Like, you can't match venture funds with a startup business. Like, to me, startups are scalable businesses, right? So every new company isn't necessarily considered a startup. So there are a ton of businesses that don't fall within that frame and don't fit within the box of venture. And frankly, if you think about the social impact investing, I would argue, and I would like to pass the ball on this, but even attracting capital as asset managers is difficult. And what is the cost of the capital for, the impact fund to then be able to return those returns to their investors? Like, yes, we're doing great work, but again, what is the cost, and then how much access is available for that? So that then puts downward pressure on the type of businesses that these social impact investment funds can invest in. And frankly, oftentimes, if you're not scalable, it just doesn't make sense. So although you may be very successful, it's just not the right type of capital, in the same way that a business loan isn't the same for a real estate loan. I think it's just different.
Yeah, and I mean, I think listening to this conversation, I think we could all agree these systems are broken. And so, how do we create new systems? And the reason why Impact America Fund exists is because there is such a need for innovation capital to test out new things. And in venture capital, the conversation around customers, you raise dollars before you have a customer in most cases, at least your early seed dollars. And oftentimes Black and brown people don't have that luxury or opportunity to raise capital, to have $2 or $3 million to play with and test out the market, et cetera, without having a customer. And so we're in a position to invest. I'm thankful when you said it, it's very difficult raising a fund of any size, but we're now in a position to invest, and I say we, my colleague Stephanie's here, who's on the team, but we can write, $250,000 checks. We can write $1 million check. We can write a $3 million check for businesses that are innovating and trying to create systems change and new structures. So one, related to this capital conversation, one area that we're looking at in our pipeline is alternative financing models, using technology to invest in companies that are building, in this case, an entrepreneur that's building a digital bank, and a company that's working with small businesses to offer a public bond, which hadn't been possible before the Jobs Act. And so those types of new models have to be invested in because the old model just doesn't work. And related to the conversation around indirect cost of capital, I think Martha brought that up. It's so important. We have a relatively small fund. We have, 15 investments made across 2 funds now. But when we look at our own cap tables of investors that are invested in alongside us into our companies, we just did a quick analysis, and we look at our cap tables, and the company that's led by 2 white women fared a lot better in terms of the time it took them to raise money and the number of investors they had to speak to than the companies led by Black men. And that time it takes to actually raise the capital is an opportunity cost and a cost of actually missing your opportunity to build the vision that you see. And so part of the work is how do we cut down on those time gaps as a big issue.
I'm going to take some audience questions. I would like to take 2 questions at a time, and I'm going to focus on people who haven't asked a question already. Sorry, just to keep it fair. So we have 2 people in the same row. Can I get 2 mics to them?
Hi, I'm very honored to witness this panel. I'm the author of the African American Financial Experience Study in 2010. It was the first study conducted by a financial services company to analyze financial behavior, and we identified then in 2010 that small business was the growth engine of of America, for Black America. I am now named the next Steve Jobs by Forbes magazine and the latest Black woman to raise over $1 million. It comes out in the Root next month. I'm now 37 in the country for the past 8 years. That's less than 1 per state over the last 8 years. Having researched this topic for the past 10 years, one thought that I have that I would love to get your feedback on is I find that grandparents and great-grandparents, especially in DC, are giving into the gentrification of the neighborhoods and selling their homes. I'm from the first Black neighborhood in the country, Kingman Park. We still own our home. I find that grandkids and great-grandkids are coming up with businesses, but the grandparents and great-grandparents, instead of taking the equity in their home and then investing it into the child, they are selling their homes. So I'm wondering, I haven't really heard much discussion around this, and I personally haven't researched it either, but I'm wondering what are your thoughts on being able to better educate the older people within the Black community to actually take the wealth that they do have and the credit scores that they do have to then invest into the younger generation, and maybe we can solve the problem ourselves. So I'm just curious as to what your thoughts might be on that.
Before you answer, can you pass the mic to the gentleman too? Thank you. And quick additional question, yes, please.
You wanna-
Yeah?
This just piggybacks on the venture capitalists' comments. January, I went to the U.S. Chamber of Commerce annual symposium, and there was some information that even I was shocked, and most of it provided by Steve Case, and that is, to give an idea of how this is stacked against people of color. 98% of venture capitalist dollars go to men who own male-owned companies. Approximately 98%. 60% goes to companies in California. 30% goes to companies in Massachusetts. That's 90%. right there. All right. So how do you break up that log jam, number one? And then there are some encouraging things. I know I happen to meet, I don't know him, but I happen to meet Andre Iguodala, who at the time was with the Warriors. He's now with Miami. He is putting together, you may know about it, all right. He's doing some really good things that are reaching out to the community in terms of VC, and also Kevin Durant, I understand, is doing some things on a local level. So those are the encouraging things. But any comment on that venture capitalist statement?
Great, let's take the first
By the
one.
way, I would suggest get on the U.S. Chamber of Commerce website and their email list. It's a good source of information. Yes, indeed.
Excellent. After you read the report, next stop is the US Chamber of Commerce website. Sign up for their newsletter. Okay, first let's talk about education within the Black community around financial literacy and what can be done best. And then, Keisha, you can take this VC question. Do you want to go first, Brian?
So first off, congrats to you. I've seen your work, so salute. I love when my Black women are doing great things. So that's first off. Second, I think really there's a financial literacy problem, right? Like, who is the one to teach the grandparents? Is it us? Is it our parents, or is it the grandparents? Oftentimes, our parents may not be equipped with the knowledge to do it, and the grandparents obviously aren't. So if it is up to us to do it, at what point do we do it? At what point do we take the liberties to start to understand what's going on in our neighborhoods? So me personally, like, the gentrification term is a double-edged sword, right? On one hand, it provides an opportunity for people to make a decision on their asset to improve the value of their lives. And on the other hand, it's disrupting the legacy and the history within these Black communities. That being said, I think the sweet spot when you understand kind of real estate is selling at the top of that market, right? I think most of the problem that I see in DC is that we sell too early. You know, so if this home is paid off because you've been there for 30 years and someone comes up and offers you $350,000, it's like, great, whoa, I've never seen this much cash before. Let me take this opportunity and then reinvest it into a community, whether it be PG or one of the local counties, and then we just kind of settle, right? However, what that person that is offering that 350 knows is that it's actually worth $7 or it's actually worth $1 million. And that's the primary issue. Like, when we start to understand the land values and what that worth is, to the point of a lot of this research, we then can sell at a higher rate. You know, if it's worth $1 million and we sell it for 1.2, I really don't have an issue with someone doing that at all, because we're on the other side of that, right? And I think understanding that is where it starts, one, and then educating ourselves and informing ourselves around what those land values are and what they should be, then informs our conversations with our elders and say, hey, I'm looking at doing this startup. I know they offered the 350. You can actually take out 5 right now. Through the revenue from my startup, I'll offset the cost of, you know, whatever the case may be, and this is how we can build together. And I think that's a more quality conversation that's then had within Black families in a way that doesn't currently exist.
Keisha, on the VC question, actually, I haven't seen this particular data, but my hunch is that the concentration in California, Massachusetts is really down to like Stanford, Harvard, and MIT. So can we talk about how you get VC money out of these super elite spaces?
It's a tough. Did I turn my mic on? Yeah. It's a challenge because it's like a self-fulfilling prophecy. It's the ecosystems are established. And as an investor, we're not investing by ourselves. We're looking for great partners to invest alongside us. We're looking for co-investors. Most deals have syndicates, and depending on how far a company goes, and you hope there's seed or angel investors. So angel investors, we're seeing more Black angel dollars being unlocked, but there's not a lot. When you think about the racial wealth gap, Black and brown people have 6 and 7 cents to the dollar. So there's just not a lot of angel capital out there where someone's going to risk the $50,000, $100,000. So I love this idea of the real estate piece of it. And then it's, you know, the Series A capital. And that you have to be in a position to write $1 million check plus $3 million check. In these larger institutions in Silicon Valley, et cetera, they're bigger. They've been around for longer. They're managing billions of dollars, so the capital's there. So then you take that ecosystem that exists. It's this flywheel that's self-fulfilling. The majority of where Black and brown people are per this map are in the South. but the ecosystems aren't there yet. There's work that's happening on the ground to develop those ecosystems, and I encourage, when we talk about programs, there needs to be investment in that development in order to create a flywheel effect where a company can grow up in an area outside of the major innovation hubs.
Let's see some more hands for questions. We've got one down here and a gentleman in the far corner there.
Hi, Taib Smith from Philadelphia. I'm a serial entrepreneur, and I've been in real estate for approximately 5 years. So my question is to Brandon, and it kind of relates to Tony's labor problem. When I talk to city council people or state representatives, they often speak about affordable or workforce housing. Now that I've been in real estate, I know that AMI, area median income in Philadelphia, goes for the entire region. So when I look at some of our projects and it says affordable, I know that it's approximately $76,000 a year in neighborhoods where the AMI is actually $17,000 a year. But when I talk to my political representatives, they don't have an understanding of the nomenclature at a granular level. And when people are speaking to community, they talk about workforce and they talk about affordable, but they're speaking over community rhetorically because they're saying to people in their face that this is not for you. So how, from a public policy perspective, when we're trying to advocate for workforce, how do you connect the reality of the nomenclature of the industry to the capital stack or to what's actually happening in community? Because I think from a public policy perspective, what a business actually like his needs is some sort of land trust or guarantee for prime property so that we have mixed income space in cities. It seems like we're algorithmically pushing people out of cities and only going to the knowledge economy.
Can I take that, before we get to it, can I take that other question? Thank you.
So I'll make this quick. I'm Bill Cunningham. I run minorityfinance.com and createinvest.com. We've been doing this for a while. Citigroup announced a $150 million equity fund.
Can you hold your mic up a little higher? Sorry, it's hard to hear.
Citigroup announced a $150 million equity fund where they're going to make equity investments in social enterprises, and they've allocated $50 million for investments in women and minority-owned companies. It's problematic because we know that white women will be the target for most of that equity capital that will come out of the bank, but I'm curious as to what you think about that. Now, lastly, we did a webinar on raising capital for black women-owned businesses. Out of that came a black woman-owned business in New Jersey who is creating a manufacturing facility for natural cosmetics targeting black women. And what she's going to do is she apparently, and I know nothing about cosmetics, what she's going to do is she's going to link to something called Instagram, right? Apparently they're all of the, I don't know, apparently there are all these cosmetics brands that have gotten a lot of traction, and specifically she wants to focus on natural cosmetics for black women using Instagram as the key marketing tool. Last thing, I'd ask you to talk about opportunity zones and the impact that will have on gentrifying the community. Finally, I see Angel is here. We did a talk at 1776 in 2015, right? Where we covered all of this. This conversation keeps happening. We can't find the black companies. We can't find the money. It's hard to raise money. We know that, So the last thing I'd ask is for solutions.
Absolutely. I think that's fair. I mean, these conversations happen a lot. I do have to admit that the framing of this question, I do think has changed, and that is one thing I think Audrey has done really well. So we take some responses to the questions. Who wants to go first?
Yeah, I'll take the real estate question. AMI, yes, as a general term, is mostly rooted in kind of the county income, not like city and or neighborhood. So I think the liberty is kind of on the developers and the operators that are working in the space, but oftentimes so it's twofold. On one hand, it's up to the developers. Like the properties that I develop, I don't actually put my rents at the maximum AMI levels. I may do 90% of the AMI, I may do 95% of the AMI, but the challenge there is on the other side. When you don't take that maximum rent, identifying the gap fillers in order to make this building work, right? Because the sources and the uses have to balance. And as you take lower rents, frankly, the uses are still there, so you need additional sources to offset it. I think there's limited resources. So oftentimes what the municipalities do is just kind of generalize it and just do what's what's best based on the resources that are available. And frankly, I think we have to be more intentional about the income types, right? So to me, I kind of view like very low income as 30% and below, right? And then workforce is 50 to 80, and the market is, 100 and above. So when we're talking about workforce housing, that's not really targeting the 30% AMI units that really represent maybe 80% of the neighborhood that this neighborhood is, in particular, going to benefit. So that's a part of, I think, having more developers being able to identify those issues and really build to that problem is one of the solutions. And then the other side, just asking for, I guess, more resources, which is difficult in a place like DC. If you think about the $100 million Housing Production Trust Fund that's here, that's probably only, it's less than 15 projects total. So how much more do we need? $1 billion annually? And then the question is, where does that come from? And then just quickly on the opportunity zone portion, opportunity zones to most people in commercial real estate is more of a buzzword than anything else. And frankly, I'm concerned about it because one of the provisions within it is that the owners of these properties within the opportunity zones have to sell their property in order for that benefit to be benefited from. And frankly, on the other side of opportunity zones, all of those funds are coming from money that is capital gains forgiven. And a lot of folks in these communities don't have capital gains to even input. So, there's a lot of uncertainty around opportunity zones at this moment, but I'm worried that, if each one of these parcels has to be sold and the billions of dollars that are raised are investing in these communities, then frankly, it could be the biggest disruptor to gentrification that we've ever seen.
Citi, yes, familiar with the work that Citi's doing, Morgan Stanley's doing, UBS is doing, Goldman Sachs is doing. So all of the big banks have launched some type of initiative to focus either on mission-driven companies and/or minority-owned companies. And for us, it's quite interesting. When I started this work in 2010, there weren't very many independent funds led by people of color. We've seen a wave of new funds in venture being launched, in early stage venture, which we're excited that are managed by people of color. And I think that's important. But as you see trends and as we demonstrate the opportunity, then larger players will come into the space. So we're thinking about, right, how do we collaborate, because it's money, it's real money that needs to be moved, but how do we collaborate in a way that doesn't extract from the communities that we're trying to serve, and that has to be very thoughtful. I think reports, I'm here from California because of reports like Andre's and what Brookings releases, the work that Ty's doing with the Black Business Development Goals we're involved in, because as this flood of capital comes into our community, how do we make sure we hold capital players accountable for real change versus, this short-term effect of great PR stories. But there's capital coming. And it's up to us how we leverage it and what we do with it.
I think I have time for one more question. I see a hand. I see one more hand right at the back. Yeah, can you just keep it high? Someone's coming behind you.
Hi. My question is around when new startups actually go into business and they are approached by VCs, how do they know that the deals that they are entering into are equitable and beneficial to them versus unequal partnerships where it may actually serve as a disservice to them? That's my question.
It's the work that we do as a Black-led venture capital fund. Stephanie's heard me say this. I'm taking off my venture capital hat, and I'm putting on my Keisha cares about you as an individual hat. And it's a fine balance that you have to walk. We want to make sure that the companies that we're investing in, and these are ambitious entrepreneurs that want to grow their businesses, those valuations that they set early on will determine how much they have at the end of the day when they sell their business. And it can get, into murky waters. And so it does take a family, a village, an ecosystem to make sure, right, there are other places that an entrepreneur can go. So if there's only, one fund in town, the fund, I have the leverage. Now that there are more funds, we're finding ourselves, thankfully, right, there's some competition. And so competition for that entrepreneur's for us to be an investor in that entrepreneur's company, put some leverage in the hands of the entrepreneur. So this is all new, this is developing, and I think it's up to us again, the more proof points that we have that this actually works, the better off we'll all be as part of the ecosystem.
Real quick, yeah.
Yeah, I think on the entrepreneur side, I think there's a lot of data out there, and there's a decent amount of resources that even on the internet you can kind of see what the general terms are starting to be. So I think leveraging that is one, but then also really understanding your business and having a pulse on how much capital you need to raise, and then identifying if that capital is worth the cost of equity. I think leverage is oftentimes a good thing. So if you can get some equity and blend it with some debt, it could be the case, and or doing it in tranches, whether it be the pre-seed and then the seed and then the Series A, as opposed to just coming out and raising all the money up front and not being able to have the revenue to justify it.
I mean, and I would just say that if you could go through community like these instead of going through a big bank, the big banks, come on, go with these guys, right? Because the big banks are it's all bottom line. But if you can get investment from within your community, you're going to be better off. And you always have to judge how much you're paying back. But if you can get it's not a better deal, still go local or whatever. I don't know, whatever the terminology is. Wells Fargo, come on.
But I will say, I must say this though, as for the entrepreneurs, 0% of zero is zero. So you also have to be willing to give up some equity if someone's going to write you a $250,000 check or $1 million check. That's money for a fund that we've spent time raising, that it's our business. So there is a partnership opportunity there.
Do you want to ask a question? Real quick.
I know. The boss gets to ask the final question. Actually, I want to come back to the core finding of this report, which is about geography and racial segregation. And I want to really direct this at Tony, because Tony is a white-owned businessman who mostly does business in majority black neighborhoods in the DC area. And most of your businesses are not financed by venture capital. So I guess what I want you to close with is, what is the lesson of survival for you and maybe your peers in other business owners who are probably near you? How can they survive given the data and the findings about the devaluation, and the market doesn't work for a lot of enterprises like you? What's the advice for other small businesses like yourself and others in majority black communities that can really succeed?
So for me, they call it the service industry, and so for me, I don't want to be arrogant, but for you guys as well, just remember they're all customers. Treat them like customers. Sometimes they're wrong, but treat the customer like the customer. And again, like the Yelp is funny sometimes, but ultimately, your neighbors, my places are all, I try to focus on, not the White House place, but the other places, I focus on the neighborhood, and they're my customers, and I try to build personal relationships with them. I still work shifts in all of my places, and again, it's the lamest thing, but treat people the way you want to be treated. If somebody comes into my place, I treat them the way that I want to be treated when I go out. And so if you're borrowing money, if you're loaning money, treat the lender. The lenders treat your whatever. You know what I'm saying? Treat people like they're you.
Before Andre comes up to wrap up, I'm just gonna say thank you for your fantastic questions, and just ask you all to quickly, like us the previous panel, to actually say one thing you want to see changed now that you've seen this report. One thing that you want to see done differently. Go this way. Give you a minute to think.
Yeah, for me, I think this kind of piggybacks off of the last question, but I think there's a lot of opportunity in the investment of a quote unquote devalued neighborhood. If you are a retail establishment and you own the real estate, that appreciation that you benefit from over the course of that time with you being in business can offset the potential cost or really lack thereof revenue that your business may generate. So I had a quick conversation with the owner of Ben's, and Ben's next door in DC. They purchased that property many, many years ago. So let's assume that it's worth $3 million now. If they have a year where they are negative 100,000, they can offset that through the $3 million of worth that they now created through the real estate assets. So I think by investing in real estate and then anchoring the business through that in a devalued neighborhood is a very, very good business proposition and yields a very, very good return.
Thank you, Keisha. One thing you want to see differently?
Yes, I am going to comment on the SEC open comments because something very important that much long discussion, but there's conversation now that Airbnb is leading around can they provide equity ownership to the homeowners on their platform. And so if you think about beyond, employees, if we can get equity, actual real equity in the hands of the community members, we can start to change the game and really have conversations about wealth building.
I guess if you know a policymaker, try to link up everything. Try to link up the affordable housing, the minimum wage, the transit. It's all related. And if you're white, just pay attention to what's going on around you. It's not that hard. I'm not that woke, but just pay attention. And, all boats rise with the tides. If black people own businesses and white people own businesses, we can erase what all these people downtown are doing and we can just move ahead. So just pay attention.
Thank you so much, everyone. Andre.
Wow, this is great. First, I want to just thank a bunch of people. Nothing gets done without a great team. And first and foremost, I want to thank David Harshbarger, my research associate who puts in work every day. I want to thank my co-author, Jonathan Rothwell from Gallup. He had to leave, but you can buy his book, Republic of Equals, right outside in the bookstore. And I also want to thank Allison Hardebeck and Carl Romer. Allison was a former intern here. Carl's my current intern, and they can tell you I put them to work. But I wanted to thank, and this goes to the comment to the gentleman from Anacostia or Southeast. When I met Amy Liu, the vice president, and when we came here, we talked about making an impact on communities. Your statement about, how can the policy world get to you? That's my charge. One of the things that we don't do as a think tank, and this goes not just us, AEI, all of them. We have events here. We give information to the muckety-mucks of the world. I want to create products for you. I want to host events where you are. None of this works, in my opinion, if it does these data, these reports don't run through your lived experience. That's what we're about. Too often, and I said this before, people will invest in Brookings and invest in me. I need for them to invest in you. So the very least I can do is show up your door and represent you. That's my job. And if we're not doing that, then something's wrong. Taib Smith, who came all that way down here from Philly, I want to thank you for that. I want to also thank my best friend Jamal, who's a small business owner here. But he's going through what all small business owners are going through. Martha, thank you for coming through, having the SEC represent. Isha, and everyone, all the panelists for here, I want to thank you, but our job is not done. We've got to get this information to you so that we can have impact. And that's it. Without that impact for change, all is lost. But I also want to say this. I want to nudge the comment a little bit. The reason why we're here is not because of grandparents making bad decisions. It was because grandparents were victimized. It was, I just want to, I mean, you didn't mean that, but I just want to emphasize there's nothing wrong with black people that ending racism can't solve. We got here because federal policy devalued black communities, and everyone in it is suffering. The white business owner, the Asian business owner, the black business owner, obviously. And we're going to need the federal government as well as market drivers to change this. But it's not going to come from blaming anyone. You know, we're not going to get there by blaming anyone. We will get there from policy correction. And when I say about know your price, it'll take us standing on our price to move policy. That's what it's going to take. So with that, that's your charge. My book comes out May 19th. You can pre-order. But thank you for coming.
I think Andre should do a book signing at my bar. And
Oh, absolutely.
Hey.
Absolutely. That's a guarantee.
we'll play Public Enemy. It'll be awesome.
Public Enemy will be playing.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.